Have you ever felt like the moment you buy a stock, it instantly starts crashing? You're not alone. Millions of traders, especially beginners, face this painful experience. And today we're going to break down exactly why this happens and how you can stop falling into this trap. Let's get real. It feels like the market is personally against you. You buy a stock full of hope and bam, it tanks the very next day. You hold on thinking it'll bounce back, but the losses keep stacking up. And it leaves you asking, why does this keep happening to me? Well, it's not just bad luck. It's a mix of market psychology, common mistakes, and emotional traps that nearly every new trader falls into. And by the end of this video, you'll have a clear understanding of why it happens and how to avoid it. The psychology behind it first. Let's talk about psychology, because most trading mistakes start in your mind. Humans are wired to follow patterns. When a stock is going up, your brain screams, "Don't miss out! This is your chance!" It's called FOMO, the fear of missing out. And it's powerful. You see the stock climbing and feel like you're missing easy money. But by the time most people notice a stock is trending up, guess what? It's already near its peak. The smart money institutional investors and experienced traders have often already bought in when prices were lower. So when you finally jump in, buying near the top, the market's natural cycle kicks in. Profit-taking begins. The big players cash out, the stock dips, and you're left holding the bag, wondering what just happened. Common mistakes new traders make. Let's break down the common mistakes that amplify this pain. Point number 1, buying on hype. You hear a hot stock tip on social media or news and jump in without research. The hype pushes prices up temporarily, but when it fades, reality kicks in and the price corrects. Point number 2, chasing green candles. Seeing a stock rise rapidly feels like a signal to buy, right? Wrong. This often means the move is already overextended. Buying into a green candle spike can lead to buying near the peak. Point number 3, no entry strategy. Most beginners buy based on feelings, not strategy. Successful traders wait for pullbacks, support levels, or confirmation signals before buying. Jumping in randomly? That's gambling, not trading. Point number 4, ignoring market sentiment. A stock can drop not because of anything wrong with the company, but due to overall market conditions. Economic news, interest rate hikes, or geopolitical tensions can affect all stocks. Point number 5, lack of risk management. No stop loss, no exit plan, holding on to losers hoping they'll bounce back. Sound familiar? Without a risk management plan, losses can spiral out of control. How to stop this pattern? The solution now. Let's get into the solution. How do you stop buying stocks right before they drop? Point number 1, control your emotions. Recognize that FOMO is your enemy. When a stock is already pumping, resist the urge to chase. The market isn't running away. There will always be another trade. Point number 2, follow a strategy. Successful traders use strategies like 1, buy low, sell high, look for support zones. 2, breakout trading. Wait for price confirmation above a key level. 3, pullback entries. Wait for a dip after a strong trend before entering. Backtest strategies. Know why you're buying before you click buy. Point number 3, do your own research. Never buy just because someone online said so. Look at the company's fundamentals, earnings, news catalysts, and technical charts before making a decision. Point number 4, understand market cycles. Stocks move in cycles. Accumulation, uptrend, distribution, downtrend. If you buy in a distribution phase, you're essentially buying near the top when smart money is cashing out. I've actually created a video breaking down market cycles in detail. Check it out. It will help you understand how to identify these phases and make smarter trades. Point number 5, use risk management. 1, always set a stop loss to limit potential losses. 2, position size properly. Never risk more than 1 to 2% of your total portfolio on a single trade. 3, have an exit plan before entering the trade. Point number 6, practice patience. You don't have to trade every day. Sometimes the best move is no move at all. Wait for high probability setups. The vision, what success looks like. Imagine a future where you no longer feel like the market is against you. Where you enter trades with confidence, knowing you have a plan. Where your emotions are in check and your results improve consistently. Picture this, you're calm, collected, and making strategic moves while others panic. Your account grows steadily, and you're no longer just hoping, you're executing with purpose. That's what trading with skill looks like. And it's achievable when you stop letting your emotions control your trades and start following a solid plan. Final words. The next time you feel that urge to buy a stock just because it's going up, pause. Ask yourself, am I buying because of FOMO or because I have a solid strategy? Remember, successful trading isn't about luck. It's about skill, strategy, and emotional discipline. If you found this video helpful, hit that like button and subscribe for more no-nonsense trading insights. Comment below. What's the biggest trading mistake you've made? Let's learn together. See you in the next one!